I mean, there's so many things you can do that aren't necessarily the popular thing of, trying to buy that In-N-Out burger franchise or Chick-fil-A or whatever it is. You can actually do a lot of stuff there. My favorite right now has been raw land. I have a partnership that I'm doing with a guy that buys and sells raw land. I have a partnership that I'm doing with a guy that buys and sells raw land. And I'll tell you, I mean, I had $100,000 invested. So far, it's over $5,000 a month of cash flow. So I'm pretty happy with that.
Amazing, brother. That's great. I mean, are these like raw lands in the emerging markets?
Yeah.
In the tertiary?
Yeah, raw land. Yeah, raw land, but you become the bank, right? You seller finance it to, you buy it from me for $8,000 or $9,000, $10,000, and then turn around and it gets sold for $25,000 or $30,000, and then they pay you on terms over 5 to 10 years, and you're getting that cash flow in. And I've told my clients, I said, yeah, I'm making $5,000 a month. Now, if I were to live on that money, I'd probably only pull out half because I know some of that's principal they're paying me. But still, if I have $100,000, I can still, even just now after 8 months, be able to pull out $2,500 a month.
Yeah,
that's a pretty good return. I mean, that's 30% rate of return on my money right there.
Okay.
I'm building it up. I'm reinvesting it so that it builds that cash flow up bigger and bigger and bigger, and then start to pull out some cash flow from it.
Beautiful. No, that's very, very exciting. What you're saying is you're taking the myth out. The reality is that savings, and I don't know Dave Ramsey that much, but I've read his book. But, saving and no debt and everything, what to do with the cash. I'm not promoting anything, but we got to use the cash to bring money. I mean, it just got to be moving. Velocity of money is what I really talk about, in my different
shows, right,
all and my syndications and everything like that. Diversity. I mean, not putting all the eggs in one basket. You got to divvy it up so that you're not taking all the risk in one particular sector, but you got to diversify and have 12 different passive streams of income, coming into your part.
Well, it's funny, people talk about diversification, right?
Pardon?
It's funny that people talk about diversification all the time, right? And they'll say they're diversified by investing in mutual funds. But the truth is, in the asset classes, mutual funds, stocks, equities, bonds, they're all paper assets. It's the same asset class. You're not really that diversified. Now, somebody might argue to say, well, Chris, I mean, you're doing raw land, you're investing in apartment buildings, you're buying single family homes, you're investing in oil land, you're investing in lots of different places, but a lot of that's real estate based. Are you really diversified? And the truth is yeah, I am. Now, granted, it is in the real estate asset class, but if there's any asset class that's got more certainty other than having control of my own business, right? And even then, that's not 100% risk free, because governments can shut you down by calling you a non-essential business, as we saw 2 years ago. But even then, other than that, I mean, real estate really is one of the most sure bets to make sure you have a real asset, something that's tangible, that's real, not some arbitrary numbers on a piece of paper. It's like people now talking about Bitcoin and Ethereum. It's like, that's great. And the technology is amazing in the blockchain, but just know that's not really an asset. That's not something that holds any real value. Right? It's just based purely off what people value it for. And most of the money has already been made in it. I remember investing in it early on when it was much lower. And now I've made most of that money. Now all the suckers are moving into Bitcoin and blockchain type stuff now, after the fact, right? That's not the place you try to gamble.
The thing is, because I think decentralized, the whole crypto, the blockchain, I'm not talking about in this show, but I'm getting somebody come in to the show, because that is where the economy is going. And I think, again, you may have different opinion on it, but I have very different opinion. I'm very big on Bitcoin, very big on, cryptos and the Bitcoin, especially with the 21 million maximum, of the coins and so forth, and how it's going to progress. And then Ethereum and the Terra Luna, and then the Ruon, these coins, there are a lot of pop.
You got to go outside the traditional Bitcoin.
Yeah, exactly.
Really is what you got to do. Because Bitcoin has become Fed controlled already. And most people don't even realize it. They don't realize that the feds remember they buy assets, right? They use assets and they sell off their balance sheet and such. They've been buying the Bitcoin like crazy.
Yeah.
Especially when it was getting up around $50,000, $60,000. They're the ones driving it up, and then they would sell it, make it crash, buy it again, run it up, and then sell it again. Mm-hmm. I mean, really, the feds now own a lot of the Bitcoin and controlling the price. That's why we haven't seen it move anywhere. That's where it's really going. And then why they do that? Because the Fed's job is not to control inflation. The job of the Fed is to protect the dollar. That's their number one concern. If they see anything trying to compete with it, they will go after it. It's just like JP Morgan did 10 years ago, and they got sued $1 billion for buying up a crap load of gold. And remember, gold market is way bigger than Bitcoin, way bigger. There's way more money there in that market. Right. And still JP Morgan was able to manipulate it to the point where they got sued $1 billion by the government for doing that, by the SEC. Same thing, the feds are doing with Bitcoin with much less cash, right? So that's where you have to be careful. Like, again, it's good to be diversified. Like, I have Bitcoin still, right? But I did sell out a lot of my positions after it hit a high. I said, hey, I'm going to pull a lot of my money out of there. We got some Ethereum, we got things like that. But again, I'm not using that as a cash flow play, because if you're not financially out of the rat race, that's not really the place you should be putting a lot of cash into, right? Because it can be easy come, easy go. You got to build yourself, get yourself out of the rat race. And then as you start to grow your wealth, and then you look to diversify and get in different places, then you can start increasing some of those positions in those different areas.
I agree. I totally agree with you. I think, you have to have the risk factor profile, and also where you can lose the money. You get big rewards. Like, in my case, I'm just recording this publicly. But anyway, I'm into Bitcoins and all, very big. And the good part is that I've done 300% and all because of the right choices I made, but you have to be willing to lose. And that's, it's just one part of, smaller part of my whole net worth that I'm investing in it, because it's going to stay. Blockchain is here to stay, and it's going to be bigger and bigger and bigger. So, we cannot promote anything. By the way, we are not attorneys. We are not advisors. I want to let everybody know, not CPAs. So this is only for entertainment purposes only. We are not selling any securities or anything. But again, we have different, opinions of diversifying. And that's what we are talking about. Any other thing you didn't talk about, Chris, that you would like to share with the audience?
Hi, you are listening to Syndication Made Easy podcast. We will be right back after this short break.
Hi, thank you so much. This is Vinney Chopra, and thank you for subscribing to my podcast and YouTube channel and Facebook pages and all the great things, and LinkedIn. Connect with me. I come live to you every Friday at 9:30 Pacific with Vinney and Bo show. Please also look at that. And also the podcast, which is my Apartment Syndication Made Easy. The book I wrote a couple of years back became international top seller on Amazon International now. And then we like to bring great guests for you every week or twice a week sometime to give you a lot of great knowledge. So please subscribe. You give us 5-star reviews on the iTunes. The better the guests we can bring, and our ranking will go higher also. Thanks again for following us and really getting the most out of it. Please comment, like, share, because we would love to bring better and better material for you.
Yeah, there's one strategy I try to use with all my alternate investments. Understand that a lot of times people will say, Chris, well, I don't really hear a lot about this. I mean, obviously, if you listen to these shows, you do. But they'll say, yeah, but nobody really talks about this. I don't hear financial advisors talking about it. Just understand, financial advisors are not financial experts. They're just salesmen in suits, right? Yeah. They offer you what they are legally allowed to offer you, which is only stock market, right? Mutual funds, annuities, really it's just mutual funds and insurance. That's typically what they can offer. Sometimes they'll do some stock trading or bonds and things like that. But for the most part, it's kind of like what I refer to as Mexican food. Mexican food has the same ingredients, whether you're buying a burrito, a taco, a tostada, chimichanga, it doesn't matter. Enchiladas, they all have some of the same basic ingredients. They're just packaged a little bit differently. And that's all financial advisors offer. And so when we look at the suite of things we can do, there's really a big, like you were just saying, there's really a big world of what's available, but it's not going to be promoted publicly. It's not going to be something that's really going to become popular, because financial advisors don't make a commission on it because the Fidelities, the Goldman Sachs, and the Merrill Lynches, they're not offering real estate investments, right? They're not offering those. And REITs don't count. When people say, oh, I do REITs. Nope, not real estate. It's a paper, it's a copy of the copy.
Yeah, very different, very different. And the
very different
of the, tax laws and everything, cost segregations and paper losses, all that, nothing.
You don't get that.
1031s, nothing is there. You're so,
Yeah, it's just a fake image. It's like a mirage of real estate, right? Because you can make money in real estate, but you can still lose money in REITs, So those don't count. I mean, we really are talking about something that financial advisors are not allowed to offer. Okay. Now, along with this, now you can definitely get out of the rat race. One strategy I've taught my clients as well to help kind of supercharge it a little bit more is that most of our clients, like they just say, all right, now we get this money deployed. We're going to take the returns from our investments, build it up in a savings account, right? But remember that savings account earns you 0.0%.
Yeah.
And then you get taxed on 0.0%. So you make very, very little money on it. So an alternative savings account that I use is actually with whole life insurance, where we do like the whole infinite banking concept. Now, beware.
By the way, I'm life agent. I don't know if people knew that. I'm declaring today I'm a life agent also in California. And I love the concept of these IULs and annuities and everything and the whole life with the, what's that? Whole life. Sorry. Go ahead. Infinite banking is the other thing.
Yeah.
To say you want to
beware the problem with infinite banking though is most of the time it's done in really incorrectly, or it's just done poorly.
Wait a minute, hold on. You're touching something. Share that. What's wrong with that? Because I had some people on my podcast, 3 people I can think of who are doing very much big time infinity banking. What's the drawback? Can you share?
Yeah. Well, the drawback is, so I used to be a big fan of like just, investing in the stock market, right? Obviously, I was anti whole life as a financial advisor. It wasn't until I met some real estate investors that told me, no, whole life's the way to go. Now, I didn't question it a whole lot. I did a little bit because I was life insurance licensed for 4 years up to that point. But I said, you know what? You guys know better than I do. Obviously, it's working. You guys are using it. Great. So I bought my own. I remember in 2006, I bought my own policy. I bought 2 of them, in fact. I was putting in about $12,000 or so a year into these policies. I put in a total of about $25,000 or so. And then year 3 comes around during 2008. And remember, I went in the hole. I was actually in the hole $16,000 a month that eventually led to me going in debt $1 million. And I couldn't afford to pay the premiums.
Oh, wow.
Well, even though they were big infinite banking fans, Nelson Nash, all that kind of stuff, I had no cash in that policy. I had to I lost both policies. After paying in over $25,000, I lost it because there was no cash to keep it going. And that's the downside with whole life, is that whole life is front loaded, where most of the insurance costs are up front, and then they get cheaper over time. Now, IULs, I used to sell VULs and then IULs even before they became popular. When I did those, the problem with those is that they start out cheaper, but then they get more expensive as time goes on. It's just like term insurance, and invest the difference, right? So those aren't a great option either. And by the way, in IULs, you can lose money even if the stock market doesn't lose. So be aware, you can actually lose money in IULs, which is why banks won't lend on them.
Oh, wow.
Only insurance companies will lend on their own product. So anyways, whole life though was way different. I kind of made it my mission to figure out how to do it differently. And over the years, we got it to the point where now very little comes out in cost in the first few years, and it starts paying for itself within just a few years, in fact. So it becomes more of a tax-free supercharged savings account. So minimal costs, highest return is really what the goal should be. And by the way, even if somebody does infinite banking, even if they give you cash from day one, doesn't mean it's the most cash. I just had somebody who sent me a quote with a company I write with, and still they were overpaying a couple $1,000s a year on the same thing they could have done with us, right? And so actually that's what they're quoted. Luckily, they didn't do it yet. I have had people where they've lost a lot of money. One of the worst cases, I had somebody who's been putting into their plan for about 5 or 6 years. And just by still paying the same amount, but moving over to the plan that we did, it would make them an extra $2.25 million in 20 years, doing nothing more, not even gambling in the markets, just more certain whole life, right? For those of you who don't understand, whole life is like term insurance, but it has this cash value, tax-free savings. It's kind of like having a Roth IRA attached to your life insurance. Now,
very interesting.
If you get it,
so you can actually pay premiums and write them off too in your taxes. Did I hear correctly? No.
Sometimes you can do that too. Yeah. I mean, if you use it for business purposes, you can write off the interest that you pay. So here's the thing that you want to do with it. Everybody tells you with infinite banking that it's a supplemental retirement down the road. But what about today? It's kind of like my sign says, right? It's live life today, not tomorrow.
Yes.
Well, what you can do, this is where the real magic happens for us as investors. If you come from this from an investor perspective, you start to realize insurance guys don't think like investors. So here's what you do is that you want to build up more cash in these things. So say that you end up building up cash of $100,000, right? Just like you would with a savings account. Now remember, the savings account pays you 0.0%, and then you get taxed on 0.0%. You really don't make any money in those things. We're losing to inflation. Well, here in the whole life policies, I can save it up like a savings account, very much so. You can create a minimum and a maximum amount that you contribute. And you have that flexibility to be able to contribute however you want if you do it the right way, not the traditional way. And what happens is that it grows tax-free, comes out tax-free, just like a Roth, but there's no stupid limitations. You don't have this $6,000 or $7,000 a year limitation you can put in. You can put in up to 25% of your stated gross income each year. So you can put it up to a quarter of your income. You can also don't have to wait till 59 and a half to touch it. So unlike what most people teach with whole life, which is why they design it this way, where you have to wait a few years to even get access to money, you can have access to money from day one.
Wow.
And that's the way it should be set up. So you have access to money from day one. So instead of waiting till retirement to maybe have something, and by the way, if you just use this only to save for retirement, it's horrible. It will lose every time to real estate investing and everything else.
Yeah.
But if you use it to enhance it, here's how you do it. You have this cash that's in here. You can do this with a savings account too, but you won't make as much money. With this money, you're earning, let's say 5% tax-free, right? You're earning 5% in here tax-free. You can also get a line of credit from a bank at 3%. So imagine you're making 5%. Instead of just withdrawing the money, so you lose the ability to make 5% on that money, you keep it all in there. So if you have $100,000, it's earning 5% that year, right? But you just borrow at 3%. So you made $5,000 that year, but that $100,000 loan you pulled out only cost you $3,000. You just made $2,000 or 2%. Now you take the $100,000, you go invest in real estate, and say you only make 10%. Well, now you made $10,000, but now add the $2,000 on top of it, you just made 12%. So your 10% now became 12 using the same money. Remember, if you liquidate a savings account, you make nothing. It just goes in, you make 10%. But here, because we can make a spread, just like the banks do to us, where they take our money, they borrow money from us out of our savings accounts, paying us .nothing%, and then loan it to us at 3, 4, 5+%. They're making a spread. We're just going to do the same thing to them. We get a lower rate of a loan rate from the bank. We turn around and invest it while we're still making money here. We make money in two places at the same time. That's where the real magic happens. And again, it's not about the life insurance itself. By itself, it won't make you enough money to really be financially free. Nothing will that a financial advisor offers you. But when you use this strategy and it's designed correctly, so the minimal costs come out, allowing that money to grow faster here while also still investing it over here at the same time, now you're double dipping on your investment returns. Now your money is making money in two places at once. That's where the real magic and power comes in.
Love it. Love it. Love it. How many great nuggets you have shared, Chris. Appreciate you, brother. Thank you. Thank you so much. How can people reach you, by the way?
Yeah, they can do one of two ways. They can either follow our podcast, The Chris Miles Money Show, on iTunes or YouTube, or you can just go to our website, moneyripples.com.
Moneyripples.com. Please see the show notes also, guys. And thank you, Chris, for hanging out with me today. Thank you. If you like the content, please share, comment, and give us 5-star reviews so that we can rise higher and higher in the iTunes and so on. Thanks again for watching. This is Vinney Chopra, Syndication Made Easy show. We'll see you next time. Thank you so much.